In today's video, I'm going to talk about how you can take money out of your 401k or IRA 100% tax-free. Hey folks, this is David McKnight, best-selling author of The Power of Zero and Tax-Free Income for Life. In today's episode, I'm going to explain how you can take money out of your 401k or IRA tax-free in retirement and spend it on your lifestyle. I'm also going to discuss the holy grail of financial planning, what you can do to shield yourself from a doubling of tax rates over time, and my latest book, The Infinity Code.
All right, I am here with best-selling author David McKnight, author of The Power of Zero, Look Before You Alert, Tax-Free Income for Life, The Volatility Shield, and very soon to be released, The Infinity Code. David, what is the release date if you have one on The Infinity Code?
It's looking like September 27th if all goes well, so sometime this month.
So very good, and I understand that that book is a bit of a novella on the concept of modern monetary theory, MMT. Is that correct?
Yeah, it's a little bit longer than a novella. It's actually a full-length novel. I mean, it's 75,000 words. So Volatility Shield was a novella, which also couched a financial principle. But this one couches an important financial principle, but it's a full-length novel. So you have to budget some time for it.
Yeah, and I'll probably bug you more about the details of that. But for today, I wanted to kind of focus on your book, the one that started it all, The Power of Zero. This book, when it was initially released, had a very profound impact on a lot of advisors, myself included. I always tell people that you were initially a mentor of mine through your literature, but now you're actually a mentor of mine, which is great. And the Power of Zero financial planning worldview is a little bit at odds with the traditional financial planning worldview. And there's a reason for that. You didn't just make these strategies up, giving people 4 to 6 different tax-free streams of income in retirement. There's a very specific reason that was the catalyst for this, which is in a rising tax rate environment, is it optimal to be doing all of our savings in tax-deferred vehicles? And so I guess, David, what is the reason that you believe that taxes will be higher in the future than they are today? And what should we do about it in terms of allocating our assets?
Good question. So basically, our country is facing a math problem of gigantic proportions. Okay, so we essentially have promised way more than we can afford to deliver for Social Security, Medicare, and Medicaid. All of the other government programs that politicians like to squabble over are not really the issue. So-called pork barrel spending is not going to sink our ship of state. But the 3 things that will potentially sink our ship of state are Social Security, Medicare, and Medicaid. And the reason why these 3 programs are so underfunded is because of a demographic glitch back, our parents' generation. It's called the baby boomer generation. They had much fewer children than their parents did. They had almost 30 million fewer children. Okay, so we went from a situation where at one point in time we had 42 people putting money into Social Security, for example, for every 1 person that took money out. We are now in a position where only 3 people are putting money in for every 1 person that takes money out. In another 10 years, that's going to be 2 people putting money in for every 1 person that takes money out. So we actually don't have enough money to pay all of the baby boomers that are marching out of the workforce and onto the rolls of the retirement or entitlement programs. And so we have to borrow money to be able to make sure that all of those people get essentially the Social Security that they qualify for, as well as to pay for Medicare. Medicare really is the big issue. It's 5 times more expensive than Social Security. And that's really what's going to drive debt up over time. And so we promise more than we can afford to pay. We're throwing it all on the national credit card. And the interest on that is growing and compounding over time. And you combine that with the fact that it looks like interest rates are returning to historically normal levels. And we may soon get to a point where the entire federal budget will be consumed by just servicing the interest on the national debt. And so it's very easy for politicians to do these types of things because they're short-term decisions that have long-term repercussions that may not even hit us while they're currently in office. And so a lot of experts believe, including former Comptroller General of the federal government, David Walker, who knows more about these numbers than anyone else on the planet, they have actually opined that tax rates will have to double sooner or later to be able to keep our ship of state afloat and be able to pay for all of these different things. And so the problem with this is that most Americans who are putting money into 401ks and IRAs as they save for retirement are living in the old paradigm. They're living in the paradigm that states that put money into these types of tax deferred programs, get a tax deduction today, postpone the payment of those taxes to a point sometime in the future because your tax rate will likely be lower in the future. And so you have this arbitrage that ultimately works out for you and makes your money last longer over time. Well, the problem is, if we're marching into a future where tax rates have to double to keep our country solvent, then we should be doing precisely the opposite of what we've done historically. So in other words, we should be paying taxes today, putting those after-tax dollars into things like IRAs, 401, Roth 401ks, doing Roth conversions, those types of things. Pay the piper today so that 10 years, 15 years, 20 years from now, when we're taking those dollars out in retirement, we've already done all the heavy lifting. We can take those dollars out tax-free. So we're in different times call for a different paradigm.
Yeah, that's amazing. And I know that this kind of flies in the face of what people have always been told. However, if you lay it out like that, then a lot of people are very conducive to going along. They love the Roth. They love the Roth conversion. You might get a little bit of pushback when it comes to actually doing the conversion and giving the IRS a check before they absolutely demand that you do so. You talk a lot about the LIRP, which is definitely a unique tool in the financial planning realm. And I know that guys like you and me are actually often accused of beating up a little bit too hard on tax deferred investments like 401ks and IRAs. But I always point out that if contributed to properly, and if you have the right balance in that bucket, they are actually our favorite. It's actually what we refer to as you, and I borrow your phrase, the holy grail of financial planning. Can you explain how that might be the case? Because we just beat the heck out of the tax deferred bucket.
Sure. Yeah. A lot of people think, oh, tax rates are going up, therefore I should convert every last dollar in my 401k or IRA to a Roth 401k or a Roth IRA. The problem with that is that if you pay taxes on all of those dollars, by the time you get to retirement, you won't have any income left. All of that money will be coming out of your tax-free bucket. And that seems great, but there's actually a problem with that approach. By the time you retire, most likely all of the deductions you enjoy during your working years will have vanished into thin air. The only thing you'll have left is what's called a standard deduction, which if you retire today, as a married couple, is $25,900. What does that mean? That means you can experience income from any number of sources up to $25,900 without paying any tax at all. If you have converted all of your IRA or 401k to the tax-free bucket, then you have this standard deduction that's sitting there idle. You won't be able to use it. So what that means is that you needlessly paid a tax along the way so that you could take money out of a tax-free bucket when you should have, had you been a little bit more intentional, proactive about it, you should have left some money in that tax-deferred bucket so that you wouldn't pay tax on it. You take it out, have it be offset by the standard deduction. You then take that money out tax-free. And the reason why I like to say it's my favorite investment is because if it's an IRA, you got a deduction on the front end. It grew tax deferred. And then by using your standard deduction to offset the tax when you take it out tax-free. There really isn't much else out there other than an HSA that allows you to do that. And so when we talk about the holy grail of financial planning, you're absolutely right. It's the only tax-free stream of income that really does that. And so it's a great complement to all the other streams of tax-free income that we talk about.
Yeah, and that's great. That's a really cool, I don't want to call it a trick. It's just an option that people are really not aware of. And what's even more important is that if you are receiving streams of income that are what we refer to as tax-free, they are not on the IRS's radar. There is another big benefit to that on top of just not owing the income tax, which, by the way, we're not saying don't pay your taxes. We're saying pay it on the seed of your investment now rather than later on the harvest. And if you have all of your income coming from Roth IRAs, LIRPs, RMDs that are below your standard deduction, that also prevents your Social Security from being taxed as well. And when we run the numbers, we find that those who have their Social Security taxed run out of money 5 to 7 years sooner than those who don't. And that's a big deal.
Huge. Absolutely. Yeah. Most people don't realize that their Social Security can be taxed. And when they find out, they're super mad because it feels like a double tax. It felt like a tax when it came out of their check to begin with. And then when they get it back, it gets taxed again on the back end. So yeah, the IRS keeps track of something called provisional income, which is the income they track to determine if they are going to tax your Social Security. And unfortunately, any dollars that you take out of your IRAs and 401ks in retirement count towards the thresholds which cause Social Security taxation. So when you let those balances in your tax deferred bucket get too big, you'll get to a point where at age 72, the IRS forces you to take these dollars out, and the amount that they force you to take out may push you above and beyond the threshold, at which point your Social Security gets taxed. So if you understand this ahead of time, and you also understand that we're marching into a higher tax rate, environment, then you can do some shifting today at historically low tax rates, get that balance down low enough so that RMDs can be offset by standard deductions and also not be so high that they cause Social Security taxation.
Yeah. So, and I can hear some people asking right now, well, David, I Roth 401k, that sounds great. Roth conversion, that sounds great, but I make too much money to do those things. So is it true that the same limitations that apply to a normal Roth IRA, do those apply to Roth 401ks and Roth conversions?
No. So if you make more than $214,000 of modified adjusted gross income as a married couple, you can no longer do a Roth IRA. That does not apply to Roth 401ks, and that does not apply to Roth conversion. So I did a podcast once on Mitt Romney. He's got over $100 million in his IRA. He could convert every last dime of that money to a Roth IRA all in 1 year, even though his income far exceeds that $214,000 threshold. So so Roth 401ks, Roth conversions don't have the same income limits that apply to them that the traditional Roth IRA does.
Okay. And just one more question to really, if somebody is still having some heartburn about paying the taxes today to inoculate themselves from having to pay them later at higher rates, remind us how low they are today and how high they have been in the past.
Yeah. So, last 2 years of World War II, the highest marginal tax bracket was 94% on any dollar you made above and beyond $200,000. Today, we're at 37%. That's the highest marginal tax bracket. The reason why I talk about highest marginal tax brackets is because that's sort of a bellwether for what all the other tax brackets are doing. So for example, back in 1960, the highest marginal tax bracket was 89. The lowest marginal tax bracket was 22. Today, the highest is 37, but the lowest is 10. So now deductions and offsets have changed and over time. But the point is, as I say in chapter 6 of my book, The Power of Zero, we are in the midst of the tax sale of a lifetime. And once we hit January 1st, 2026, today's tax rates will revert back to what they were in 2017, which means that they will all shift up. 37 goes to 39.6. They all sort of shift up commensurately. So if you're thinking about shifting money to the tax-free bucket, you really have, if you count this year, you have 4 years during which to take advantage of historically low tax rates. And folks, every year that goes by where you fail to take advantage of historically low tax rates is potentially a year beyond 2026 when you could be forced to pay the highest tax rates you're likely to see in your lifetime.
Great. And just wrapping up to kind of summarize this, in a rising tax rate environment, there is a very specific amount that we want to have in each of our different buckets in terms of savings. So in our taxable immediately liquid bucket, we want to make sure that we have at least 6 months of living expenses in the event of an emergency. In our tax deferred bucket, we want to be taking that free match from our employer, getting the free money and everything, but we don't want it growing too large so that when we take those RMDs, they overwhelm our standard deduction. And then everything above and beyond that should be piled into the tax-free bucket, which includes Roth IRAs, Roth conversions, LIRPs. That way we can basically set ourselves up, ideally speaking, for the 0% tax bracket in retirement.
Couldn't have said it better myself. If you need some help implementing the strategies I discussed in today's video, head on over to davemcknight.com and opt in for a complimentary strategy session. I'm happy to lend a hand. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.